Stocks are starting to lose their footing, and at the exact same time, precious metals are moving like the market just heard news most people haven't processed yet. Gold didn't just drift higher, it pushed through a psychological ceiling and closed above $5,300 an ounce, with one of its biggest one-day gains in years. Silver didn't just follow, it sprinted, posting a surge of more than 7% in a single session. Let that sink in. Now pause, because the point isn't simply that gold and silver are up. The US 10-year yield has been hovering around the mid-4% range, roughly 25% around January 28th. That means money has an opportunity cost again. It also means the market is not pricing a clean, effortless glide path back to ultra-low rates. And yet, gold is ripping. That tells you the bid is not just lower rates optimism. It's something closer to distrust, hedging, and a global portfolio decision that says, even with yields where they are, owning some monetary insurance makes sense. And that's where gold's role is uniquely powerful. Gold doesn't need earnings growth. It doesn't need a new product cycle. It doesn't need a narrative about innovation. Gold is what capital reaches for when it wants exposure without counterparty risk, when it wants a hedge against currency drift, when it wants an asset that doesn't default. So when gold closes above $5,300 per ounce, it's not a trivia fact. It's a psychological event. Now, silver. Silver is more dangerous. Silver is more emotional. Silver is the market's pressure valve because it sits at the crossroads of two worlds. In one world, silver behaves like money, like a cousin to gold. In the other world, silver behaves like an industrial input, a real material demanded by real supply chains. And when those worlds collide in a tight supply environment, price action stops being polite. Here's the structural piece most people miss. According to the Silver Institute and Metals Focus, the global silver market has been expected to remain in a sizable deficit again, with 2025 demand around 1. 20 billion ounces, supply around 1. Just 5 billion ounces, and a projected deficit of about 149 million ounces. Let that sink in. 149 million ounces. A deficit like that doesn't mean the world runs out overnight. It means the market is consuming more than it produces. And it has to make up the difference from above-ground stocks, recycling flows, and dishoarding. That's fine, until it isn't. Because repeated deficits do one thing over time. They thin the buffer. And when the buffer thins, price becomes less stable. That's when moves can turn violent. Not because of a conspiracy, but because the system simply has less shock absorption. Now add industrial demand. The Silver Institute has highlighted industrial fabrication trending at historically high levels, with projections surpassing 700 million ounces in 2025. That's not speculative demand. That's not hot money. That's real consumption across electronics, energy, and industrial applications. So ask yourself a simple question. If industrial demand is strong as a baseline and investment demand rises on top of it, where does the extra metal come from? The answer is, it comes from inventories, until inventories say no. And when the market starts to suspect the no is getting closer, price changes fast. This is why silver behaves the way it does. In a calm market, silver feels boring. In a stressed market, silver feels like a live wire. And right now, it's acting like a live wire. Now bring this back to the title. Stock market weakness meets precious metal rally. The key word there is meets, because what matters isn't that stocks are down a little or up a little. What matters is that stocks are struggling to extend smoothly, while metals are breaking upward with urgency. The S&P 500 touching 7,000 intraday and then backing off isn't automatically bearish, but it is a sign the market is no longer gliding on autopilot. It's a sign that every new high needs more effort, more confirmation, more participation, more belief. And if belief starts to thin, hedges start to outperform. That's when gold and silver stop being optional and start being relevant. Now, stop for a second and think about the mechanics. Precious metals are priced through a complex structure: spot markets, futures markets, ETFs, vault inventories, and global arbitrage between hubs like New York and London, and increasingly Asia. Most people think price goes up because demand goes up. But in metals, there's a second layer: leverage. Futures markets allow large exposure with relatively small margin. That's what creates liquidity. And it's what creates instability. In a rising market, leverage acts like gasoline. In a falling market, leverage acts like gravity. So when silver posts a massive one-day jump, the market can be driven by real demand, hedging flows, currency effects, and the reflexive behavior of leverage all at once. That's why silver can be up 5%, then down 8%, then up 6%, without any headline that explains it. The explanation is often positioning and forced behavior. And that brings up something critical: technicals. In big metals rallies, technical signals don't just describe price, they influence price. When metals clear major resistance, round numbers, prior highs, key moving averages, new participants step in, short positions get pressured, and momentum strategies activate. At the same time, the risk rises. Because when price moves too far, too fast, the market enters what traders call an overbought condition. That doesn't mean it must crash tomorrow. It means the probability of sharp pullbacks increases, sometimes brutally. In fact, analysts have already been warning not to chase silver when it becomes extremely stretched, precisely because the whipsaw risk becomes huge in parabolic phases. So here's the balanced truth. The kind of truth that doesn't get clicks, but keeps people solvent. The structural thesis can be bullish, and the short-term path can still be dangerous. Both can be true at the same time. Now, what's the macro link tying stocks and metals together? Confidence. When equities are strong, the default portfolio assumption is growth will solve it. When equities are expensive and begin to wobble, capital starts asking harder questions. What happens if growth slows? What happens if policy support is limited? What happens if debt dynamics get worse? What happens if the currency weakens? And what happens if geopolitical risk rises in a way markets can't price cleanly? In those windows, gold's role rises. Not because people suddenly become gold bugs, but because portfolio math changes. Gold becomes less about getting rich and more about not getting wrecked. That's why central banks have been building gold reserves in recent years, reducing reliance on dollar-based reserves. Especially after geopolitical shocks made reserve assets feel less neutral. So, when gold surges and holds above $5, $300, it's not just retail enthusiasm. It's a reflection of global reserve behavior, currency uncertainty, and institutional hedging. Now, the stock market side of the equation. The S&P 500 is representing roughly 80% of U.S. equity market capitalization, and it has been driven heavily by narratives around technology and AI, along with earnings optimism and the idea that policy will eventually become friendlier. But here's the risk with any crowded story. When everyone believes the same thing, the market doesn't need bad news to shake. It just needs reality to be slightly less perfect than the price implies. And when prices are stretched, even minor disappointments can create a change in tone. That change in tone is what metals often sniff out early. Now let's talk about history carefully. History doesn't repeat exactly, but it rhymes. One rhyme is what happens during moments of stress, like 2008 or March 2020, when liquidity shocks cause sell everything behavior, and then a powerful re-hedging wave arrives. Another rhyme is what happens in commodity mania phases, like 1979 to 1980 in precious metals, or silver's 2011 blow-off, where price accelerates, the story spreads, and then volatility punishes anyone who confuses momentum with certainty. The lesson is not metals are a bubble, and the lesson is metals can overshoot and then punish, which means the right approach is not emotional certainty. The right approach is risk-aware clarity. So now, let the bearish case breathe, because ignoring the bearish case is how people get hurt. First bearish risk, a dollar reversal. If the dollar index finds a floor and rips higher, it can create headwinds for metals quickly. A weaker dollar has been supportive, a stronger dollar would not be. Second bearish risk, yield pressure. If yields rise sharply, the opportunity cost of holding non-yielding assets increases, and metals can face selling, at least in the short term. Third bearish risk, forced liquidation. In high volatility environments, margin requirements can rise. Traders can be forced to sell winners to meet obligations elsewhere. When that happens, correlations go to 1, and even gold can drop temporarily. Fourth bearish risk, demand destruction in silver. At extreme prices, some industrial demand can be deferred or optimized. Silver is vital, but behavior changes when input costs spike. That can cool demand at the margin. Fifth bearish risk, the crowding problem. When too many people pile into the same trade late, price becomes fragile. A small pullback turns into a cascade as stops trigger and momentum flips. Those risks are real. Now, here's what those risks don't change. They don't change the structural deficit dynamic in silver. They don't change the role gold plays when confidence shifts. They don't change the fact that stocks hovering near record highs can still be vulnerable if breadth narrows and leadership weakens. And they don't change the underlying message of the divergence. When metals rally hard while equities hesitate, the market is telling you that hedging demand is rising. Not necessarily panic, but preparation. So what does this imply? Depending on who's listening, for long-term investors, the implication is about allocation, not excitement. The question becomes, does the world look more stable or less stable over the next several years? If the answer is less stable, then the case for holding some monetary insurance becomes structurally stronger. For traders, the implication is about timing and volatility. Silver can deliver massive upside quickly. and then take it back just as fast. That means risk management matters more than conviction. In a market like this, the worst habit is chasing candles. For those focused on physical metal, the implication is about premiums, availability, and long-term purchasing power. Physical markets can behave differently than paper markets in stressed periods. Spreads can widen, inventory can tighten, and emotions can spike. The disciplined move is to think in time horizons and avoid making decisions purely off today with price print. Now, here's the part that should make you pay attention. And it's simple. A divergence like this is a spotlight. It forces a question that can be ignored forever. Is the world moving into a period where financial assets remain the center of gravity, or into a period where real assets regain their role as the anchor? Because if the answer shifts even slightly toward real assets, gold and silver don't need hype to move. They reprice because capital rotates. That rotation is what turns a quiet trend into a loud one. Now the actionable piece. Without telling anyone what to buy, what to sell, or what to do, 3 things to watch continuously. Watch the dollar index. If it remains weak in the mid-90s or drifts lower, it supports metals. If it snaps higher, expect turbulence. Watch the 10-year yield. Around the mid-4% zone, metals have been rallying anyway, which is notable. But if yields surge, expect pressure and volatility. Watch equity behavior, not headlines. If the S&P 500 can't hold breakouts above 7,000 and starts rolling into repeated sell-offs, hedging demand can intensify. If equities regain broad participation and confidence, metals can pause or pull back, even if the long-term thesis remains intact. And now, a verification moment. Spot prices can differ by source. Moves can be exaggerated by intraday volatility. Narratives can be wrong. Verify independently. Check multiple price feeds. Check major market summaries. Check official data releases. And separate fact from interpretation. Because the goal isn't to believe a story. The goal is to understand the mechanism. Now, full risk disclosure. Precious metals can be extremely volatile, especially silver. Price can move sharply in both directions without warning. Past performance does not predict future results. Markets can remain irrational longer than participants expect. Liquidity can disappear. Correlations can flip. Policy decisions, geopolitical events, and shifts in positioning can overwhelm fundamentals in the short term. This is educational market commentary, not financial advice. No outcome is guaranteed. Any decision involving markets should consider risk, tolerance, time horizon, and position sizing. Because even correct ideas can become damaging when timing and leverage are wrong. So here's the closing message. Clear and direct. When gold is breaking record territory above $5,300 an ounce, when silver is surging in single-day moves that almost never happen in calm markets, and when stocks are hovering near historic highs but struggling to extend cleanly, the message is not get excited. The message is pay attention. Because this is what regime shifts look like at the beginning. Not a crash, not a siren, but a divergence. Stocks are telling one story, confidence and continuation. Metals are telling another story, hedging, currency doubt, and preparation. And when those 2 stories collide, the next phase is rarely quiet. It's not getting late. It is getting late for ignoring the signals.